Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Today's video, this is my normal subscriber request series that I do. I do it every Tuesday, so you can watch for it. And this particular series, I'm going to cover a sector that's very interesting, the consumer staple sector. Now, I'm not covering the entire sector, but I am going to be covering 5 companies that I was asked to look at, all of them in the consumer staples. Now, if you're not familiar with what they are, they're often also called the consumer defense sector. And it's things that we use in everyday life, food, clothing, etc. These are all going to be companies that are related to the food industry. So go ahead and let me right into it and show you the 5 consumer staples that I currently like right now. Now, when I'm picking these subscriber requests, one thing I want to be clear about is if a subscriber asks me to do this and I decide to do it for him, that does not simultaneously say that I endorse investing in the stocks. Now, in this particular case, these 5 companies here, all of them have PE ratios that are at or below my 15 PE threshold that I talk about quite often. That gives me an earnings yield of 6.5% to 7%. I only have one company here that's just a tad above that. That's General Mills, and I'll show you that in a moment. But I've got very attractive earnings yields. Now, there's something else that I think is very important. When I'm looking at stocks like this, these are very good quality, everyday, usage stocks. We got Bng Foods, General Mills, the cereal company, of course, Kellogg again, in cereal, Kraft, Heinz, which is a very interesting one, which I'll cover, and then Tyson Foods, which is known for their chicken. All right, so what I'm going to do here is I'm going to cover all of these stocks, and I'm going to do it from strictly through FastGraphs, okay, what FastGraphs are showing me. But one thing I want to point out is this. I always say it's a market of stocks and not a stock market. So let me start by looking at the stock market. If you're looking at the average company as measured by the S&P 500, I want you to note that the S&P 500 is trading at a blended PE ratio of 26.5. That's an extremely high valuation. It gives me an earnings yield of 3.77%, which is roughly half of what I am considering a minimum expectation for investing in a common stock. And then the dividend yield is also 1.57%. So if I compared this from a valuation, additionally, just on the dividend yield, you would see this is on the low side. When the S&P's dividend yield is this low, when the S&P's dividend yield is high, like it was in December of 2008, we had a dividend yield of 3.09%. That's when the best values are. That's when you can make the most money investing in the S&P 500, or an individual stock for that matter. In contrast, when the dividend yield is very low, like it was here during this period of time, when the valuation was very high, that's when you could go through a long extended period of time of not doing very well investing in the index. So an index is just like a common stock. There's a right time to buy it and a time not to buy it. Okay, so what I'm going to do is I'm going to go through these 5 consumer staple companies. We're going to start by looking at the individual FastGraphs. I'm going to start with Bng Foods, which is a packaged foods and meats company. Now, if I go into their external links here and look at it from the standpoint of the company's corporate website, it'll give you a little insight into what the company does and what their brands are. So let me take a quick look at their brands. And these are brands that you'll recognize, most of them or some of them. You've got Crisco, of course, which is famous, Green Giant, Ortega, Clabber Girl, which I'm not real familiar with. You got Accent, Baker's Joy. So you can see this is a conglomerate of a lot of different brands that the company markets and sells throughout their various industries. Now, here's what I want to point out when I'm looking at these stocks. Valuation is very, very important to me. So let's talk about Bng Foods. First of all, it's got an earnings growth rate of 8.47%. That's reasonably attractive. Of all the stocks I'm going to cover, it has the highest dividend yield, 6.21%. Now, what's interesting about that is, investors don't always invest to try to make as much money as they possibly can. Sometimes you want to invest for certain strategic initiatives like income. You want to get the highest dividend yield you can. In today's low interest rate environment, that might make a company like Bng Foods attractive. But I also want to point out that this is a very volatile stock. Now, people like to measure that with things like beta. I like to measure it by looking at it. If I just look at this graph, and it goes back to 2007, which is when this company initially went public, you can see that there's been a lot of volatility. The stock price has really been all over the place. There's been periods where we had these extremely high valuations where the PE was almost what it is on the S&P today. Then you've had periods of time where the PE was very low at 10 or 11. Today, the blended PE is about 13.55. You can see that it's dropped into what would be classified as fair value territory. And the company looks very interesting from a valuation point of view. So if I'm looking at the future here, we're not expecting much growth, maybe 3.61%. There are 11 analysts that are forecasting that virtually no growth for 2021, and then only 4% for 2022, followed by 8%. So they are looking for a little bit of acceleration. If I go to the 3 to 5 year trend line, I don't get any estimates at all. So the point is, we're not looking at something that's going to grow very fast. So if I look at the company historically, you can see a couple of things that I also think are challenging. Number one is the company's dividend payout ratio, which is the area below this white line, at times gets very high. Back in 2014, it was 94%. There are times when it's, even 81 or 82%. So if I go into the performance report here, the Fast Graphs performance report, this report allows me to look at payout. There was a time when it was 200%. In other words, they were paying out more money than they were actually earning, and that's a red flag to me. So we have these very high payout ratios, which I consider to be a challenge. The company's very volatile, but it is inexpensive today. And if you did buy it today and looked at it just growing at 3 or 4% a year, and it ended up trading at a 15 PE ratio, which I would call normal, this could generate double-digit rates of return over the next couple of years, all the way out to 2023, 12.96%. However, a significant portion of that return is going to come from the dividend yield, which isn't expected to grow very fast. I want to point that out. In fact, it's not expected to grow at all for this year versus last year. So it's something to consider. The company has 73% debt, and it's only B+ rated. So it's a good company. We know their brands. Their brands are reasonably popular, as I showed you earlier. But the real point is here, this isn't a stock that's necessarily going to make you a lot of money. And I think you have to be concerned with the fact of the volatility. I mean, there are times when the stock has gotten hot since it's been public, and there are times when the market was treating it like it had leprosy, if you will. It was a really bad company. Today, the valuation at least is attractive. Now, another thing I like to look at when I'm looking at these stocks is I like to look at profit margins. And this also gives you some additional insight. This is a bar graph. I'm going to draw this as a line graph, so I think it gives you a little better perspective. Notice that the gross margins actually are reasonably high for this company. You can see those numbers down here in the 20 to even up to the 27, 28% range. But their net margins are about 7 or 8%. Now, occasionally they sneak in, a double-digit margin, net margin. But the bottom line is this company, is not the kind of company that you can necessarily invest in with perfect confidence. You have to be careful with it. The next one, of course, is General Mills. Now, this is a different story. This is an extremely high-quality consumer staple. We all know the company. We know their cereals and so on. So it's another packaged foods and meats company. It has a better debt profile, and it's BBB rated, which is pretty good for these consumer staples here, considering the fact they don't grow. Now, General Mills has grown on average at about 6.18%. I want you to focus on that. The current dividend yield is 3.53. It's significantly better than the market. This one is trading about a 15 PE ratio as of yesterday's close, with about a 6.5% earnings yield. But I also want you to notice that the market does have a penchant for valuing this stock at somewhere around 17 times earnings, or maybe even a little higher. I'm not really talking about these periods where we get these extreme valuations. But a 17 multiple is not bad. So there is a possibility this stock could move back into alignment with that quote-unquote normal PE. So when I'm looking at the future here, I'm looking at 3% growth. There are 18 analysts that are giving me that for the next fiscal year, which ends in May, by the way. So we got a fiscal year end coming up in just a couple of months, a little more than a quarter. And then, by May of 22, we're looking for only 1% growth, followed by 5% growth. Now, if I look at the 3 to 5 year trend line growth rate here, it's going to average about 5%. If I look at historical growth rates, and I use my little handy drop-down in Fast Graphs, you can see that 4 or 5% is a pretty good proxy for what I would call normal growth. Occasionally we get 6, 7, or 8% growth. So, I'm pretty comfortable using the 4.77%, which has been the historical last 5 years. And this means that I've got a nice solid, 7 or 8% rate of return from a stock that's, selling products that we use every day. It's got a decent earnings yield and a decent dividend yield here. And if I look at it from a standpoint of historical performance, I do want to make a point that the real significant attraction here is the dividend. It's done okay against the S&P on a capital appreciation. I can use different time frames here, and that number changes. So if I drop it down a few years here, we're going to see that it falls a little further behind at times and so on. But the reality of it is you can buy this stock today at an attractive valuation. I might want to wait and get it a little cheaper, but you ought to invest in it with the right expectations. Know that this isn't a fast grower, does have a decent dividend yield and a good long-term history of increasing their dividend. And the average dividend growth rate has been, about 6 or 7%. So, 6.9 to 7%. Those are good numbers and good expectation of dividends. Now, they haven't increased their dividends since 2018 after COVID. You should also be aware of that. My point is I'm always taking these things into consideration. But I do want you, once again, to see that in the long run, this company's stock price has tracked earnings, as they always do, in my opinion, eventually. Now, they get periods where they separate. We had this, high valuation coming into 2016, which eventually reverted to the mean, and it got undervalued, and it eventually reverted to the mean. Then it got overvalued again a little bit in 2020, and now it's kind of reverted back to the mean, or at least it was by the end of February. It was trading at a below 15 PE, but it's still very, very buyable today. If I look at this stock from a standpoint of the fund graphs, I got a similar story with margins. I'm going to go ahead and convert to the line graph. Margins have held up for the last 6 or 7 years. The net margins actually been okay, but these are not high margin, which partially explains why they don't grow very fast. These are just good, solid companies that give you a decent income and a decent, return with, probably a lot of predictability and safety. Now, next we're going to go to Kellogg's, and again, we get a very similar story here. Historical growth has been about 4.34%, as you can see here in the green area. It's grown about 4.34%. And I think the important thing here has been reasonably consistent. In other words, there is a little bit of cyclicality occasionally, but the company essentially covers its, the company does make money every year, and they've got a pretty decent dividend record again. If I look at the long-term growth rate, it's been about 4%, which is consistent with how fast the company's grown. Occasionally they do, they're conservatively run. They did freeze their dividend coming out of the 2001 recession for 3 or 4 years, but they didn't cut it. They maintained the dividend. I think that's really an important story to tell here. So Kellogg is another one. It's got a 6.78% earnings yield, which is attractive by my measurement. It's got a dividend yield of 3.8%, which is very attractive. Now, if you're looking for a stable, staple, if you will, income producing investment, again, you don't buy a name like Kellogg's or any of the others I've shown you or will show you here in this video to try to, make a killing in the stock market. You're buying these companies for their stability and their ability to generate good income for you and maybe, protect your capital. Growth of Kellogg is not expected to be very high, only about 2% by, 18 to 19 analysts. So again, this isn't a growth story. This is just a solid rate of return, 5 or 6%. If that appeals to you, that's one you might want to consider. If not, then I would, skip it. From a standpoint of margin, I found this story kind of interesting. The gross margin has actually been falling here in recent years, but the net margin has actually been holding up and even getting a little stronger. So maybe they're getting a little more efficient. But anyway, that's Kellogg's. You asked for it. I'm giving it to you. So anyway, now let's move on to Kraft Heinz. I mentioned that I really find this company quite interesting because it's been thrown around like a ping pong ball here. That Philip Morris bought them and then they spun them off and then they were spun off again. And, this company's, changing its stripes almost every time you look at it. And I find this one to be a little bit challenging here. We all know what they make and their products, their Kraft products, the cheeses and everything. But here was a case of a company that got very, very pricey, back in 2015 and 16. And it's a good story about valuation because the company's stock price collapsed. They ended up cutting their dividend in 2019. And then 2020, they didn't grow at all. Of course, that was COVID, but they did okay. The stock price actually got very undervalued for a couple of years, even on these subdued earnings. And then it's been rallying again and coming back. Now, looking forward on this stock, again, we see actually a negative growth rate forecast, but that's from 2020. For 2021, we see 11% negative growth from 2020, but then we see, 1% growth and 3% growth. So once again, we don't have a story here that really there's no estimates given for the long-term growth. It's a yield play, 4% dividend yield, 7% earnings yield, blended PE of 13.7. But you ought to be looking at the stock with realistic expectations. It's not growing very fast. Now, another thing that I found very challenging about this stock is when they've gone to periods where their margin has completely disappeared. So it's very erratic as far as, something that I can look at and say with, a great deal of confidence, I think this company will consistently give me a decent growth or decent margin. It's a very, very challenging stock, in my opinion, at this juncture. And you can see the history of it. Earnings have been, pretty cyclical. They did slash their dividend dramatically from 2018 to 2019. And the dividend's not really expected to grow very much. So this is all about just getting a 4% yield with good value. And maybe even you want to look at a stock like this that you'd want to trade. And then last but not least is Tyson Foods. And what's really interesting about this one is this one might actually have some growth characteristics compared to the others. It's one of the highest rated of the group. It's BBB+, just, one notch below A rated. It only has 39% debt. Growth rate has been 11% going all the way back to 2001. But if I shorten this, substantially back down into 2010, you see that growth rate's almost 25%. Let me take one more year off because that's an anomalous growth rate there. If I get rid of that, we've got a 9 or 10% growth rate. So I consider that rate pretty attractive for the company. It's forecast to grow double-digit. Now, this one has a September fiscal year, okay? So this stock, will end their year in September, and it trades at a blended PE of 13, has an earnings yield of 7.7, and an above-average dividend yield of 2.42%. So I really like it from that point. If I'm just measuring performance over this time frame, I want you to notice the stock was undervalued. I want you to see, based on both the orange earnings justified valuation, which I consider the intrinsic value line, and or the normal multiple line. The market has tended to value this at around 11 or 12 times earnings. So it's a little bit above that, but it's still below the intrinsic value. Nevertheless, from a performance point of view, it's outperformed the market on dividends and it's outperformed it on capital appreciation, although, just barely, just by a little bit. When I look at the future here, it's expected to grow at 8.5%. And if we go back to that 15 PE ratio, we could have double digit, 18 to 20% annualized rates of return. And this is a calculator here. I want to make this clear. I'm able to just do quick calculations. If I invested in Tyson Foods, what can I rationally expect to make if everything goes according to what everybody believes right now? And I can make 22%, 21.6% by the September quarter ending in 2022, and I could make 17.8. Now, if I go to the normal multiple, which has been slightly lower, and now for the last 5 years it's averaged about 13, then I'd be looking at making 13% or 12.8 going out to 2023. So this gives me a good rate of return. If I look at longer term growth on this stock, it's only again expected to be about 2.5%. These consumer staples are not necessarily fast growing, but Tyson has been, at least in recent times, one of the fastest growing ones of all. When I look at their margins, I get a little different story here. I see a company who's actually been increasing both their growth margin and their net margin in recent years. And their margin has been growing at 8 or 9% a year. And I think that's a key to future profitability. So of all the group here, if I was looking to try to make as much money as I could, I think I'd be looking at Tyson Foods here, even though I might want to, based on how the market likes to value it at a discount, I might want to get it just a little bit cheaper. Anyway, this has been Chuck Carnevale saying, I hope you enjoyed this subscriber request here. I want to remind you again, I'm covering these companies not because I chose them personally, but because subscribers request. I didn't cover all the consumer staples, but the 5 I did cover here are all reasonably valued. But again, you should invest with your eyes wide open. This is not about making the most money. Anyway, if you like this video, don't forget to give me a like, ring the bell, and if you haven't already done it, please follow me. I've got a lot more to come. Every Tuesday, I'll be doing these subscriber requests. These are companies that the subscribers, you, the subscriber to my YouTube channel, have asked me to cover and do a video on. So I'm doing that at your bequest. Thanks for watching. I appreciate you guys, and look forward to next Tuesday when I do another Fast Graphs subscriber request Tuesday. Thanks for watching.